Joining us now on set with his value playbook is Bill Nygren from Oakmark Funds. Bill, it's great to have you here.
Thanks for having me, Morgan.
We've been having a lot of these conversations recently about whether the market is expensive here and we're due for a pullback or even a correction because of it. How do you see it, given the fact that you are this long-standing, formidable value investor?
Well, the way we look at it at Oakmark, the S&P 500 is trading just a little under 20 times earnings. Doesn't look particularly cheap to us at that price. But what's unusual now is after that really strong growth outperformance in the first half, the spread between PE multiples of the expensive stocks and the cheap stocks is getting back up to historically unusually high numbers. So even though the S&P is at 20, we've got a bunch of growth stocks at 40 to 50 times earnings, and then a bunch of value stocks that are still at single-digit multiples. So we think the opportunity is there to put together a pretty inexpensive portfolio.
I want to dig into that a little bit more, but this idea, and we saw it play out last year, and certainly at Oakmark as well, this idea that tech is a value play. Can we say that that dynamic or that chapter of the market has come to a close then?
I don't know that it's really come to a close, but it's certainly not as attractive as it was last year. Last year, we were using kind of alternative valuation metrics that we thought did a better job of identifying value than GAAP accounting did to buy stocks like Uber at a double-digit free cash flow yield or Adobe Systems when that was barely at a premium to the market for a great business. And those stocks have performed incredibly well. So they've found their way out of our portfolio, and the replacements tend to be more of these single-digit PE names in the banking industry, insurance sector, energy, legacy media. So those names seem attractive.
More traditional value, if you will. So I guess what are some examples of some of these more recent names that have found their way into the fund?
Well, we've added to positions in Comcast and Charter, single-digit PE multiples. I think investors tend to worry too much about video cord cutting, and we think the companies should be given infrastructure-like multiples for their internet access business. With the banking crisis at the end of the first quarter, we thought that got overdone. We were able to increase some positions there, including adding names like First Citizens and Truist, where we think the regionals kind of all got painted with the same brush of concern that there'd be deposit outflows. We think both those companies have very strong, well-diversified, transactional-based deposit franchises. We've added in the auto sector to our position in GM, which was a clinker today, but and maybe you could say has been for the past decade. But we think they're finally nearing the end of this stage where it seems like there's always another use for the cash they generate, and finally they'll have an ability to start returning it to shareholders.
Yeah, I do want to go back to financials for a moment, because to your point, there was a lot of throwing the baby out with the bathwater and all the regional bank turmoil, and that hit the broader financial sector as well. Charles Schwab was one of those examples, and I think for me it raises the question of how do you assess the health of these companies and decide what to invest in when there are different metrics and different accounting methods that could be at play and that we know have affected the stocks?
Well, I think we need to look at some of the metrics that GAAP accounting doesn't pay a lot of attention to, like a breakdown of the deposit franchise. How strong is it? How well diversified is it? How much is it transactional based versus investment based? Because when interest rates go from 0 to 4 or 5%, we all get more careful about how much money we leave in our bank accounts that aren't paying much interest income. I think also on the asset side of the balance sheet, need to pay attention to the duration of the assets and like how far those assets have fallen in value because interest rates are higher. And we've got a mix of those in our portfolio. Companies like Capital One, where the durations are shorter, they could probably sell the asset side of their balance sheet for more than book value today. A company like Bank America that we also like because of their strong deposit franchise, they will be under-earning for a couple of years because the duration of their portfolio is a little bit longer.